Hey everyone, welcome back to Corporate Decoder, the place where we take boring corporate filings and turn them into something understandable and maybe, just maybe, a little bit interesting. Today we're diving into Royal Caribbean's latest proxy statement, and trust me, even if you're not sailing anytime soon, there's some juicy stuff here about executive pay and where the company's headed. Think of it as the ultimate cruise ship gossip, but with numbers. This isn't just about fancy vacations. Royal Caribbean is sharing their plans for the future, their strategy for growth, and how much they're paying their top execs to steer the ship. This proxy statement is like a roadmap, revealing where they're going and how they plan to get there. It also asks shareholders to vote on some key issues, like electing directors and approving executive compensation. First things first, Royal Caribbean had a killer 2024. Total revenues hit $16.5 billion and they made a profit of $2.9 billion. That's a major comeback and their stock is reflecting this success. Load factors, meaning how full their ships are, average above 108%. That means they were selling more tickets than they had beds. People were fighting for spots on these cruises. They also saw significant pricing strength. This means that people were paying more for cruise tickets and onboard spending. To really dig into that success, let's check the numbers. The filings boast a 23.8% surge in gross margin yields. That is a huge amount of money flowing, and net yields, which is a better measure to see the real picture here, up by 11.6% compared to 2023, all in constant currency, of course. That excludes the impact of currency exchange rates. This is serious cash, folks. They are rewarding shareholders as well. Royal Caribbean reinstated their quarterly dividend and increased it 38% throughout the year. The share price went up a lot, so it may not be as impactful. It's not just about money though. Royal Caribbean is talking up their environmental responsibility too, claiming they achieved their goal to reduce carbon intensity by double digits 1 year early. They also diversified their energy portfolio using more LNG-powered ships and biofuel. Alright, let's talk about who's steering the ship. The first proposal is the election of 13 directors to the board. The board consists of industry veterans, former CEOs, and financial experts. It's a pretty stacked team, and the filing gives a little bio for each of them. The board recommends you vote for all of them, of course, although one person, Mr. William Kimsey, is not standing for re-election. Check out Richard Fain, the chairman and former CEO. He's been with the company since 1981. That's some serious experience. And Stephen Howe, former US chairman of Ernst & Young. He brings some financial muscle to the table. Of course, there's Jason Liberty, the current CEO. The board is very proud of its diversity across gender, race, skills, and experience. Most members are independent, a very important detail to ensure no one person has too much control. The filing specifies that independence is defined by guidelines to avoid material relationships with a company. Now, how do they pick these people? The Nominating and Corporate Governance Committee uses a third-party search firm to find potential candidates. Shareholders can also recommend people, but they have to meet pretty strict standards. The goal is to ensure the board has the right mix of skills and experience to guide the company. Here's a key governance point. The board is separating the roles of chairman and CEO. Mr. Kimsey is the current lead director and is very active. The new lead director will have significant power such as calling meeting, advise on meeting agendas, facilitate communications. Want to know who really owns the company? Kevin. Institutional investors like Capital Research, Global Investors, and the Vanguard Group hold the biggest chunks of shares. Then there's Abel Ashenas, connected to the Wilhelmsen family, one of the original founders of the company, and the filing includes details about how many shares the directors and executive officers own, aligning their interests with the long-term success of the company. And the filing includes details about how many shares the directors and executive officers own, aligning their interests with the long-term success of the company. Here comes the money. Proposal 2 is an advisory vote on executive compensation. This is your chance to say whether you think the top execs are being paid fairly. The board, unsurprisingly, recommends you vote for it. They highlight that their executive compensation program aligns the interests of executives with shareholders. So how are these guys paid? It's a mix of base salary, performance-based annual bonuses, and long-term equity awards. A significant portion of their pay is at risk, meaning it depends on how well the company performs. This is a good thing. Aligns top managements with the shareholders' goals. They put together a neat graphic showing all the incentives. The higher one goes, the more variable their compensation. Equity compensation, meaning stock and options, is a big part of their pay packages. This is intended to motivate executives to focus on long-term growth and increase shareholder value. Proposal 3 is about ratifying the selection of PricewaterhouseCoopers as the company's independent accounting firm. The audit committee is responsible for this, and they're asking shareholders to give their blessing. This is really just a rubber stamp though. Now, the interesting part, the filing includes a breakdown of the fees paid to PricewaterhouseCoopers. Audit fees, audit-related fees, tax, and all other fees, which totaled $5.4 million. The bulk is, of course, for audit fees at $4, dollar fees at $4.6 million. In a bit of a goof, 2 forms reporting restricted stock awards were filed late due to some paperwork mix-up that is disclosed in the section called Delinquent Section 16 and Reports. A very small amount, and it looks like nothing malicious, so we will move on. The board oversees a number of corporate responsibilities, including the health and safety for travelers, environmental sustainability, and good corporate governance. The goal is to be fully transparent and accountable. So the corporation has been putting out corporate responsibility reports since 2008. They check to see how they measure up using the scale of the Global Reporting Initiative. Lastly, the corporation is not aware of any conflict of interest with all members of its board of directors or material transactions with these members. It says so right in the document. So what's my take after looking at all this data? Royal Caribbean has made a remarkable comeback. Their financial results are strong and their stock price reflects that. The company is clearly focused on both growth and sustainability, which is a smart move in today's world. The executive compensation seems well aligned with performance, and the company has strong governance practices in place. I see some risks they mention in the report, including the effect of weather and natural disasters. However, they have a solid plan to go forward. Overall, it looks like Royal Caribbean is charting a course for continued success. The company is showing they are leading the industry into the future, not just back from what it was in previous years. What do you think? Do you agree with my assessment? Let me know in the comments below. Don't forget to like and subscribe for more deep dives into the world of corporate filings. Thanks for watching.